Yeah, you're absolutely correct because what we're seeing right now is a lot of geopolitical noise, which is affecting the overall share prices for a lot of companies. But then, as noted earlier, the fundamentals for a lot of these companies are still very good. When we started to see some of these companies and when they were recording or when they were reporting their first quarter 2018 numbers, they were very good. When you sort of look at some of the underperforming sectors, I think the one thing that some investors might have overlooked is the fact that when you look at some of the IT companies, especially the ones listed on the A shares, they've actually underperformed by quite a significant margin. When you look at the IT shares listed on the A shares, basically they've underperformed the CSI 300 by about 20% over the past 2 years. Whereas if you look at the IT stocks, which are listed outside of China or here in Hong Kong, or as well as the ADRs, they've actually outperformed MSCI China by about 30% over the past 2 years. So there is definitely a widening gap, and valuations for a lot of these A-share hardware tech names are actually very cheap, with a lot of them actually trading sort of around the 15, 20, 25 times earnings levels.
Ken, aren't some of those hardware names, though, seen as the most vulnerable to the current trade tensions? We know the U.S. administration wants to go specifically hard on Chinese tech.
It is. So that's a very good point, where if you look at overall emerging markets and the IT sector, they account for about, the U.S. in particular accounts for about 25% of overall revenue. So anytime if there is going to be talks of trade war, there's going to be a big impact for those IT stocks. That's why you have to be very careful in terms of what type of IT stocks you purchase. As I mentioned earlier, a lot of these mainland listed A-share companies, if they're trading roughly around 15 times earnings, while if you look at some of the counterparts listed in Hong Kong or elsewhere, they're at 25, 30, 35 times earnings. So you definitely want to look for the ones which are definitely more cheaper now and which have underperformed.
And Ken, you did say that it's important to kind of look past the noise and focus on the fundamentals. And I'll give you that. There is so much noise out there on trade and investment from both sides currently. But at what point does this noise impact the fundamentals itself? Are we talking about this potentially occurring in the next round of earnings?
Well, at least in the short term, over the next couple quarters, we don't expect to see a lot of sort of big impacts because, again, it's still business as usual. But then by the time we get to year end, and if we do start to see, sort of earnings, revised downwards because of the fact that expectations are becoming lower, then that could have a big impact. But right now, if you look at sort of overall consensus earnings estimates for countries like China, for countries like India, and for some of the other larger Asian countries, they're still fairly solid. We haven't seen a lot of downward revisions. So things are still sort of, full speed ahead. But obviously, we get a couple more quarters of this and we start actually seeing, sort of more trade war impacts on overall corporate earnings as well as their top and bottom line, then that could have an impact.
Ken, you also like the earnings outlook for Chinese financials, as I understand it. What is your view then of the PBOC? Because many said yesterday off the back of the RRR cut that we could be seeing the start of a more steady, easy mode coming from the PBOC. Do you agree?
Well, potentially it would be one of the policy tools, because the fact is that if they're really trying to focus on the domestic part of its economy, focus more on domestic consumption, trying to grow the economy more domestically instead of focusing a lot on exports because of all these trade war tensions, then the PBOC will have to start loosening up policies and potentially, help more of the domestic sectors. And so as a result, because of those potential policies, you would expect to see potentially further RRR cuts in the near future.
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.